Welcome to Taking Stock for the week ending 6th of October 2023, where this week myself, Tim Lincoln, and Kien, our head of Stock Doctor Research, streamed you all things share market. A big welcome to you all and a big welcome to you, Kien. How are you now that we're on the back of reporting season?
I'm fine, Tim. It's good to be back. I had a trip up from Darwin and I came back here and it's starting to get very cold compared to Darwin.
Yeah, a little bit fickle, the weather at the moment down here in Melbourne, but that's early spring for you. And but the end of footy season's also upon us. And yeah, it was an interesting result. The Mighty Blues, they fell over at almost the final hurdle there in a preliminary final. So I had plenty of excitement there. Ken, it was quite an amazing run, an amazing story, and sets us up well for next year. But well done to all of those Collingwood fans and also Panther fans out there in the rugby. If you're not into the footy or the rugby, though, I hope you're all doing really well. Well, Kien, great to be here with you, as I said. But before we get started, I'll just share with our viewers our little disclaimer that all of the information we share today is of a general nature and therefore should not be construed as personal advice. And all of the data and performance metrics that we also share are all historical in nature and therefore should not be relied upon as a guide for future performance. Well, Kien, let's jump into the market. And it's certainly been under tremendous pressure for especially the month of September, hasn't it? On the back of many things that we'll get into in a moment. With the All Ords, it was down around 2.8% in September. And growth in income investors have experienced the challenging environment and the period with tech, healthcare, and REITs sold down really heavily. Meanwhile, only the energy sector managed to hold ground during that period. And also interesting, across the Pacific there, Kien, that the S&P 500 as well as the NASDAQ, all the major indices in the US were down around 5% as well for the month. So plenty of volatility out there, Kien, and be interesting to know from your perspective, what's driving that volatility?
Yeah, definitely, Tim. The overarching issue was that there was that rise in bond yields. And remember, bond yields are a reflection of future interest rate expectations. So rising yields means that the market has concerns that interest rates could remain higher for longer. And for the month, this has led to the underperformance of growth stocks, which have larger cash flows into the future. And so the value of these stocks decline more because higher interest rates have more impact on the present value of those larger future cash flows. Meanwhile, Tim, you mentioned the REITs, and property stocks was also sold down because higher interest rates reduced the valuation on their property assets and also increased the interest costs of their debt as well. And of course, interest rate expectations have risen because inflation and oil prices remain stubbornly high. Last week, annual inflation accelerated for the first time in 4 months, jumping 5.2% in the year to August compared with 4.9% in July. And in fact, even though the RBA has held the cash rate steady this week at around 4.1%, the market is pricing in a 57% chance that rates will be 25 basis points higher by December.
Yeah, those reasons for the volatility are really, really obvious, aren't they, Kien? And we simply can't ignore them. And earlier this year, we spoke about our concerns that the market wasn't pricing in a weakening economic environment, and especially with the fact that in a rising interest rate environment, those interest rates are certainly, there's a lag factor there, and the impact of the interest rate rises wouldn't really take effect until later on this year. So we spoke a lot about that, and because the market wasn't pricing in that weakening economic environment that was really indicated by that persistently high inflation numbers around the world, soaring bond yields, as you touched on, recession probabilities, and those rising insolvency levels that you'll get into in a moment, and of course weakening consumer and business confidence. There's a lot there, isn't there? So just a lot that influenced that narrative that we're talking about around our concerns that these things would take a while to take effect, especially interest rates biting. And the combination of these risks have already led to a decline in earnings expectations across the corporate landscape. And this is why we as a fund manager decided to implement tactical risk management techniques in August to help protect the downside volatility of the portfolio. So earlier on in the year, we moved to, around 30% cash in our portfolios. And then tactically, we moved that cash into bear ETFs, and we'll get into that more in a moment. And especially in my quarterly message too, I really provide quite a bit of detail around how we've moved that tactically. But that 30% position now in a bear TF is to neutralize against volatility. So if the market does decide to go down because interest rates are starting to bite, then we won't go down with the market. We'll virtually stay neutral in regard to our total return. So zero returns while the market falls. Now, all of this is based on probability though too, Kien. And with all of the reasons that we said before that are going to cause this volatility, we're making this 30% play and betting on the market going down purely based on probability. Now, we might get it wrong. But if we do get it wrong and the market rises, it doesn't really hurt us that much. It means we won't outperform, but we will still do okay because of that 70% of our portfolio is still exposed to those high quality stocks that you would think would rise with the market, especially if the cycle turns in favor of those stocks. So it's something members can do actively themselves too by buying a bear ETF and neutralizing their portfolio 30% of their holding. But you've got to be really active in that management because you've got to maintain that 30% position. You can't let it rise or fall, so you've got to be active. So what a lot of our members are currently doing, Kien, is actually getting us to manage a percentage of their DIY portfolio in our funds in order to look after that neutralization for them. So if that's of interest to you, give us a call. So thankfully, the position that we took, this active position that we took in August, is helping the performance of our Lincoln managed funds, with the Australian Growth Fund up really nicely, or outperforming the market really nicely because of that neutralized position in September, together with our US funds as well, Kien, that outperformed around 5% of the market during September. But as I mentioned before, my quarterly message, that'll be out next week also. Have a look at that, where I go into a bit more detail. And it's question of the week to follow as well, Kien.
Yeah, thanks, Tim. Risk management is so important in portfolio management. And a trend that has continued from the reporting season has been the increased volatility faced across those financially unhealthy businesses, Tim. For example, the 10 largest losses on the ASX 300 last month were all financially weak businesses, as can be seen with the table on screen. And so this is why it's so important to continue to hold those financially healthy, high-quality businesses in the current market environment to help you ride through that economic cycle and also mitigate those downside portfolio risks.
Yeah, of course, Kien. And rising volatility can also present attractive opportunities, of course. And last month, we witnessed decent share price declines across our quality star stocks like Altium, Xero, CSL and ResMed, all quality businesses that if prices want to fall in those businesses, then that obviously represents opportunity. And one of the benefits of having Stock Doctor is that you can also look for emerging opportunities, Kien, with the smaller end of the market. And I applaud you and your team for really digging and deeply and finding some of these opportunities of late. And they're often overlooked by larger broking houses. So that's, again, the beauty of Stock Doctor, allowing you to find these hidden gems before the rest of the market catches on. And you can do this by using your own stock filter within Stock Doctor, or by having a look at my filters. I've got a couple of filters in the stock filter: Tim's growth stocks with potential, or Tim's income stocks with potential. So dig around in there. It doesn't mean they're all investment opportunities. You've got to do your thorough due diligence, but it will uncover some real hidden gems.
Yeah, that's right. And one of those interesting opportunities we'd like to highlight today, Tim, is called DUG Technology. The code's DUG, and the company provides software to analyze scientific data, mostly for global oil and gas companies, so they can extract resources more efficiently. And following contract wins from large global energy companies, the business has been able to generate an attractive return on equity at 29%. and net profit margins of 9%, Tim.
Wow, the outlook appears strong too, Kien, although potential investors will need to be very mindful that there is a degree of earnings uncertainty, given that there's only two covering analysts in the stock, and you can see that in the right-hand corner of the screen there. This also means investors should be really careful when relying on valuation under Golden Rule 5, where the stock is trading at a significant discount to valuation. So just be really careful there. We generally like to see the stock covered by around 3 analysts to get that level of comfort in their forecasts.
And Tim, it's great to see that management are aligned with shareholders here, with the co-founder and managing director, Matthew Lamont, having a 20% stake in the company. The analyst team are currently reviewing this stock and could potentially include Doug Technology as a star stock in the near future if the active risks are manageable.
Yeah, and great to see your initiated coverage of a mid-tier oil producer during the week too, Kien. And that company is Karoon Energy with a ticker code of KAR. The company's primary asset is in the Bana oil field situated in Brazil. And it was interesting to see that your initiation also ties in with the recent supply side shocks after Saudi Arabia and Russia curbed oil production, which sent the price of oil skyrocketing recently, Kien. But I also noticed that its earnings profile is quite different to other energy stocks like Woodside and Santos. Karoon Energy is expected to report a large uplift in its return on invested capital compared to a significant decline across its other major peers. So, yeah, what's the reason for that, Kien?
Yeah, good observation, Tim. In financial year 23, Karoon Energy achieved several significant milestones, including a major enhancement of the Bana asset, which involved new electrical submersible pumps and gas lift devices. This has led to an approximate 40% uplift in its oil production, which has more than offset the earnings drag driven by a potential normalization in the oil price assumptions, which has led to that negative outlook for stocks like Woodside Energy.
Yeah, very interesting, isn't it? And obviously, there's always risks associated with all companies, but especially those in the energy and resource sector. So, in regard to Karoon, they only have one primary producing asset in Brazil and is highly leveraged to oil prices and regulatory changes in the region.
Yeah, and looking at the week ahead, Tim, within the corporate calendar, we have Commonwealth Bank, CSL and Brambles. They are expected to report on their AGM. So it'll be interesting, especially with CSL having been sold down quite significantly. So it could potentially be that opportunity we mentioned before.
Yeah, excellent, Kien. And now to Under the Microscope, Kien. And this week we take a look at a stock that you and your team have been able to discover via our emerging philosophies and philosophy and technique that we discussed earlier to discover some of these smaller to medium-sized stocks for our members. And this week it's electrical equipment distributor IPD Group, or their ticker code is IPG. And being the largest player within their space, Kien, the business has really strong relationships with its suppliers and customers, allowing it to win really strong market share and generate a return on equity, a very strong return on equity also, of 23.6%, and net profit margins of 7.1%, which are also solid, above our 5% net profit margin threshold. So, however, drilling into its financial health, Kien, I noticed that some of the balance sheet and cash flow metrics appear weak, even though the company has no debt and a small proportion of intangible assets. Is this a concern to you, Kien?
Yeah, an interesting point, Tim. And the reason for this is because IPG is a distributor of electrical equipment. So it accumulates inventory and has a large accounts payable liability towards its suppliers. In addition, there was a decline in its operating cash flow over the year, and this put some pressure on its cash flow metrics. But despite this, the company remains in overall satisfactory financial health, and cash flows are expected to ramp up in the coming years. So that should fix up this situation.
Yeah, very good. And I noticed earnings growth and return on equity are both expected to improve this year as well, which is great. but investors need to be mindful that the number of consensus analysts is only three. We're comfortable with three, but it's right on the cusp of what we're comfortable with to have that reliance on those forecasts. So, Kien, how can investors have conviction with the numbers, considering there are only three contributing analysts to forecasts?
Yeah, our analysts have spoken to management to understand their assumptions as well and determine whether these are realistic. In addition, investors can refer to the price-sensitive announcements under Golden Rule 8 and review the earnings guidance from management to see whether the consensus projections are consistent with those from the company, Tim.
Yeah, really good, Kien. So where there is less coverage for a star stock in regard to the forecast, or less coverage from external analysts, then your team dig even deeper, don't you, to try to talk to management, have discussions with them, and really understand those active risks in much greater detail. So that's terrific. And obviously read the analyst comments and the strategic comments, because that's where they document all of their findings from those discussions. And members could also click here on the announcement page to see the share price reaction to previous announcements, to see whether management have a track record of delivering positive news to investors.
Yeah, that's a good one, Tim. And investors can also look at the trend in their earnings under Golden Rule 4, and the positive trajectory in their earnings provides more confidence in the outlook and valuation under Golden Rule 5 as well. So yeah, that's one for you to have a look at.
And under Golden Rule 7 too, it's also great when we see that there's that skin in the game. And ex-founder and CFO, Mohammed Yusuf, he has significant skin in the game, holding approximately 6.5% of all script on issue, or $51 million worth of shares. Meanwhile, the CEO, Michael Thomas, has about $5.7 million of script as well. So great to see that they're backing their own horse, but also we must keep a close eye on things to make sure that skin stays in the game as well. And now to question of the week, Kien, and we've got this question a lot because we've been talking about it a lot to our members, and it's all about when one considers the recent downside volatility across the US and Australian share market. So we're going back to really what we discussed earlier on in the session. A useful question is, how can investors protect their portfolio against significant share market volatility?
Yeah, firstly, Tim, we would like to emphasize the importance of having the right asset allocation. So equities is considered a higher risk asset class. So investors really need to decide on how much they want to allocate to equities. And that's based on their stage of life, their investment objective, and also their risk tolerance, Tim.
Yeah, and then within the equities portfolio, you should focus on having a diversified portfolio of high quality, financially healthy businesses, whether they be for your growth objective or income objective. So a nicely diversified portfolio, again, relative to your objectives. For example, hold at least 15 stocks to reduce concentration risk. Avoiding concentration risk also mitigates the risk against significant share price declines of only a few stocks. And remember, with investing, it's near impossible to get every one of those right. And I think if you can get a ratio of around 60% right, where 60% do all of the heavy lifting and do a lot greater than perhaps the 40% that don't go up. So we've got to accept the fact that we don't get 100% right. That's reality. And having a portfolio of high quality stocks allows you to ride through the market cycles with confidence. If you're a growth investor or income investor, not always cycles are with us. That's when the percentages drop in regard to the total return of all stocks in your portfolio. However, with quality stocks, you've also got the comfort and peace of mind that quality businesses will eventually recover over the long term.
Yeah, Tim, and to protect against downside, you can also decide to be more tactical by holding an allocation to cash, as the funds did earlier in the year, Tim. And this allows you to take advantage also of oversold opportunities if the market declines even further, because you've got that war chest of cash. And it's so important because that cash allocation also reduces the risk of your overall portfolio.
Yeah, well, you've got to be active, don't you, Kien? You're a DIY investor, or we're a managed fund. We're an active managed fund, and you're all Stock Doctor members, so you're active DIY investors. So you've got to be active, and any of these positions that we take are purely tactical and ideally short term, where whether we increase our cash position or we consider other vehicles to mitigate against volatility, they're all temporary positions, and we've got to be obviously very tactical when we move in and out of the market. So a little bit more on that. I know we touched on it earlier. It's in my quarterly message coming out next week, but let's just reinforce a couple of quick points now. As I said, we employed a strategy in the last month to neutralize our portfolio from downside risk by using index futures or inverse ETFs or bear ETFs. And in our case, we've used BBOS, which is a listed ETF, a bear ETF. We've bought 30% of our portfolio, or allocated 30% of our portfolio into BBOS to neutralize the effect of volatility within our portfolio. However, when applying this strategy, it was really important that we continually be active and monitor our position and be absolutely prepared to unwind this position when the economic landscape changes, when we believe interest rates have peaked or inflationary pressures have peaked, and the full impact of those rising interest rates have had on the economy. That's when we'll obviously look to move all of that money back into the market, and at a time when we believe the market is adequately priced. So it's a temporary play. We've been very tactical and very active with the management of those positions to shield against what we believe is a high probability of further volatility. So I hope that all made sense. We love being transparent. We love sharing with you what we're doing. I hope all of that helps. And remember to give us a call if you'd like us to help you mitigate that potential for further volatility by investing in our managed funds if you choose not to do it yourself. So that's it for another week, Ian. I think we covered off on a lot of key messages. We also highlighted a couple of emerging stocks in there as well. Love the work you're doing there, and also tried to make it very clear around what we see the market doing over the next month. So thanks a lot, Kien. Great sitting down, having a chat with you.
Pleasure, Tim. And over the next few months, we will continue to look at those emerging opportunities as well, using those filters you talked about, Tim. And now it's been a great session, and I hope our investors have enjoyed it, especially around the risk management aspects of it.
Yeah, and it's all about finding those emerging opportunities early, and members, again, you can dig deeper and find them yourselves through the filters or whatever too, or we'll try to do it in a really dynamic and proactive way too. But remember, risk management is really important to help manage volatility, absolutely critical in this environment. Or you've got three choices, with one being just ride it out, another allocate more cash, or another way is to get really tactical and use these bear ETFs or buy future contracts to hedge against risk. And but don't forget too, if there is volatility, it does create great opportunity, especially if high quality businesses get oversold. But that's about it, Kien. It's bumper edition. We got through a lot. Take care, everyone, and have a happy, healthy, and prosperous week.